Hello, welcome back. This is Market Shares. I am your host, Tony Blodgett, and today I want to continue our conversation around mortgage interest rates and the Fed, because last week many of you saw that the Federal Reserve, for the first time in quite a few years, came out and changed their monetary policy. They increased the overnight cost of funds by 25 basis points. And, I think there's a lot of controversy about that. It was kind of expected that they would go 25 basis points, but with them making it very clear that they have 6 or 7 interest rate hikes to do this year and a few more to follow next year. And with everyone knowing how inflation has really gripped our society, there was a lot of people thinking they should have been a little bit more aggressive and came out at 50 basis points on that first raise, and they didn't. And the market didn't really like that so much. Mortgage rates immediately that day got worse, and then they tried to make a little bit of a rebound. But then we have this week, and our Fed chair Jerome Powell was at an event at the National Association of Business Economics. And he gave a speech there, and I thought it was really good. If you haven't seen it, I would go look for that. There was a speech and then some Q&A afterwards. And when he got done with his speech, one of the gals that was interviewing him with questions, I don't have her name written down here, but she basically said, well, that sounds like the buck stops here kind of moment or speech for Jerome Powell. And what she was referring to is he made it pretty clear that we're going to use all the tools at hand to fight inflation. So it was a very hawkish tone. And I spoke about this before. I think at the end of the day, bond traders and investors in long-term instruments like mortgage-backed securities, they want to know that inflation is being tackled and under control. But it also kind of spooks the market a little bit to know that we're going to see not just potentially an aggressive stance toward hiking interest rates throughout the rest of the year, but as I mentioned in one of my last videos, he did change the language in the last FOMC minutes about when and how they were going to unwind the assets that are currently being held on the balance sheet. And he talked about that in this meeting as well and made it pretty clear that they are going to announce in a future meeting, and almost gave the impression like they were going to be pretty aggressive about unwinding the balance sheet. So, all of this to say that this is a moving target. We're going to continually see these updates from the Fed, whether it be the speeches or the actual scheduled meetings that come out. And we're going to have to watch this very closely because the market is watching it very closely. And when this speech was being given just a couple days ago, it was very obvious that something was going on. If you didn't know that there was a speech happening and you just watched the bond market, it reacted very negatively to his comments. We lost quite a bit of room on mortgage-backed securities. The 10-year pushed up to heights that we haven't seen also in a very long time. So that's the state of what's going on. Interest rates have not gotten any better, and I really don't suspect they're going to anytime really soon. So here's my advice around mortgage interest rates. They are going to be volatile. They're going to move up and down, but the overall trend is going to be, I think, where they are and potentially even a little bit higher before we hit a peak. So if you're a loan officer or if you're in the process of purchasing a home and you're having to deal with interest rates, locking in your interest rate is always the best idea. We've seen a lot of people with these comments like this get caught, and all of a sudden the interest rate that they thought was available is gone, and there's no getting that back, without paying points or some other method to deal with that. And so I think it's important that if the rate's there and it works for you, works for your client, I would be locking in that interest rate. But here's also what I wouldn't do is I wouldn't be paying a lot of discount points right now in this market to buy the rate down, because what we do know is likely going to happen is that at some point in the not too distant future, we will see rates come back down. We know that when the Fed takes aggressive action like this, matter of fact, the Fed knows when they take aggressive action like this because Jerome Powell spoke to this, it's very often that we put ourselves into a recession. It's not always the act of raising the interest rates, the change in monetary policy that puts us into a recession, but we almost always go into a recession. I think a good example of that would be right before the pandemic. The Fed had been raising interest rates. Matter of fact, it was right in March of 2020 when they dropped the rate down to that 0 to 25 basis points. And luckily, they had a little bit of room. They had raised them up, so they had some ammunition, if you will, to fight that. But look, they had been raising rates, and we went into a recession. Now, we can obviously say that the pandemic was clearly the reason for the recession, but would we have had a recession anyways? I mean, many people think that we very well, could have. And so that's what we expect to happen this time around as well, is that when the Fed's going to be aggressive, they made that very clear. They reinforced that message, in this meeting this week. And so the likelihood is there will come a time in the near future where interest rates will come back down, because that's what happens during a recession. Now, the other good thing that happens during a recession is usually housing stays really strong. 7 of the last 8 recessions, we did see positive appreciation in home values. The exception, obviously, was the great crash of 2008, which was actually led by the mortgage market and the housing market. But every other recession, we see interest rates come down, we see home values and home sales do very well. So that's kind of what we expect this time. And the reason why I mention this, and it's so important, is because what we're seeing right now out in the mortgage market is that with interest rates going up, people know, and when I say people, I mean people that do marketing and advertising for the mortgage industry, they know that people really desire to have a lower interest rate. And so what you see right now is a lot of the online call center type companies, these online lenders, or really anybody who advertises their interest rates, whether it be on the internet, on social media, or even on TV commercials. Many of them are quoting interest rates that are associated with quite a few discount points. I see many interest rate quotes that are 2 and even 3%, 3 discount points cost to obtain that rate. And I got to be honest with you, now would be the worst time to pay additional points to get a lower interest rate. You're really better off taking that higher interest rate, saving your cash right now, and then keeping in close contact with your mortgage advisor so that when interest rates do come down, which they will at some point, this is a very cyclical industry that we're in, when rates come down, take advantage of that and refinance your loan at that time. Many times you can do a no-cost refinance or essentially be able to use the rebate from the interest rate to cover the cost. And there's always costs associated with refinancing, but sometimes you don't have to necessarily add those to your principal and still lower your overall payment. So that's my advice right now, you guys. Hang in there. This is going to be a bit of a wild ride. Inflation is our number one concern, and the Fed's made it very clear they're going to use all of the tools that they have available to fight inflation. So be prepared for that. That means higher interest rates across the board for all of the things that we borrow money for. But it will get inflation back down to their target range of 2%, and it will also more than likely create some recessionary factors in the economy. And as a result, there will be a period of time where rates come down. So set that expectation for your clients. Stay in touch with them. If you're a homeowner or a borrower, know that this is going to happen. Stay in touch with your mortgage advisor. And when the time comes, you can take advantage of the next cycle and get your interest rate locked in at a nice low interest rate. So that's really my message for today. If you enjoy this content, please like and subscribe to this page. We're just getting going with market shares, and there's going to be a lot more content. For now, we're going to talk a lot about the Fed because they're going to have a lot of control over what's happening in the market for the distant future here, the near future. So we're going to keep a close eye on this, but we also on this channel will share with you interviews with top producers, best practices, and really just shed some light on other things that I think are interesting that people want to know about the mortgage industry and the market and the market alike. So with that, thanks for tuning in today and take care. Till next time.